Okay, good evening, everyone. I hope you are well. I hope your families are also well. Welcome to another course session for financial accounting. And those that are just joining us, we've been doing a series of these. And this is Samuel Ibanda of Achievers Professional Trainers. Basically, financial accounting, we started with several topics, and we're on our journey. In the last class, we are trying to look at errors, collection of errors, and then we also, of course, we looked at the different errors that affect the trial balance and those that don't affect the trial balance, and so on. So today, we want to interest ourselves onto what we regarding as the measure, end of year adjustments, and error correction. We want to interest ourselves on the measure, end of year adjustments, as well as the error correction. Just a moment. Right. So major end of year adjustments and correction of errors. Now, one of the things that we have to know is that as accountants or as businesses, continuously, once we have, of course, our trial balance after maybe we've balanced off our ledgers, and then we have our trial balance. We've maybe looked at any errors and maybe did some error correction as well. Between that time to the time of, let's say, preparing our financial statements, we could also have some adjustments that we have to make. And those adjustments are usually, of course, they are end of year adjustments. So we make these adjustments at the end of the year before we can prepare the financial statement. So these adjustments are actually on the trial balance. You get it. Now, these adjustments are usually in different forms, and some of these could be, of course, we could be providing for bad and doubtful debts. Bad and doubtful debts, of course, what happens with the bad and doubtful debts is cases where you have sold some goods to some people and you expect that maybe they may not be able to pay you. So then you go ahead to provide for these bad and doubtful debts. This is very common when it comes to financial institutions like banks. For example, during this time of COVID, many people have to, of course, go ahead to make provisions for bad debts, because it's likely not everyone will really be able to do what, will be able to pay back. Of course, the other that we also have as one of our end of year adjustment is the prepaid expense. the prepaid expense. Now, what happens with prepaid expenses? These are expenses that you pay in advance. These are expenses that you pay in advance. Now, for example, some of you, I think you've seen, some people, because they have some good amount of money, instead of paying rent for that year, they will pay rent for the next maybe year as well, or for the next 5 years as well. Now, because we don't want to recognize all the rent for the 5 years in 1 year, of course, there's what we call the matching principle, which says that we should make sure that, of course, we match revenues and with the respective expenditures. Basically, we cannot recognize the whole amount that has been paid for the 5 years in the first year. So we shall go ahead to put some amount of money within our prepaid expenses. Prepaid expenses are usually assets. They are current assets of the business. Of course, as you see, if in most cases, these will be, of course, current assets, but in some way or the other, they can also be non-current asset. Now, you also need to know how to distinguish between a current asset and a non-current asset. Now, a non-current asset is an asset that is going to last for more than 12 months. You get it. Now, when I say that prepaid expenses can be also non-current assets, what I'm trying to mean is that you can also pay for expenses for periods that are beyond 1 year. So a portion of a prepaid expense that relates to periods more than 1 year, that would be regarded as a non-current asset. Of course, we also have incomes, prepaid incomes, just as we may prepay for expenses. Also, our customers can also prepay us for the services or for products that we supply. Now, that is called, of course, it's like incomes received in advance or prepaid income as it is there. So it's very important for us to have. I think what I didn't also speak about was depreciation. Now, with depreciation, we know very well that for any non-current asset we hold, we have to go ahead to depreciate these assets. And mostly the common depreciation methods we have is a straight line and reducing balance method, which we shall be looking at as we proceed through this topic. So depreciation is not done at the start of the year. We do this depreciation at the end of the year because the year has ended, so we want to recognize this expense. Depreciation itself is an expense. So we also have what we call accumulated depreciation. Now, accumulated depreciation is the alternative account to the depreciation account. When we depreciate our assets, we shall debit depreciation and credit accumulated depreciation. As depreciation goes to the P&L, the profit and loss, or go to the statement of comprehensive income, accumulated depreciation goes to reduce on the cost in the statement of financial position, or what you might regard to as your balance sheet. You get it. So very important for us to understand that. Then the other accrued expenses, they are the accrued expenses. Now, the word, of course, accrued expenses, mainly these are expenses that the company has incurred by the close of the year. These are expenses that the company has incurred by the close of the year, but payments, whose payments have not been paid, And in most cases, these even invoices have not yet been received. Payments and have not been paid, and also the invoice has not yet been received. Because if an invoice had been received, then it would no longer be an accrued expense, it would actually be an accounts payable. Because in that case, you would go ahead to recognize the creditor in your books or the accounts payable, and then recognize the expense. But you will only accrue when we are aware of an expense we've incurred, and maybe we've not paid or received the invoice. That is why we call it accrued expense. The same thing with incomes. At the end of the financial year, you can be at a point in time when you have maybe offered a given service to, let's say, maybe Yeah, you've offered a given service to your customers, or maybe you've given products to customers. So at the end of the year, if you've not received that income, you can also go ahead to recognize that income. You get it? Because you've earned it. It's an income that you've earned. You've been able to provide a service. You've been able to, let's say, not only providing the service, but you've met the terms of the contract. So you should be able to recognize that income. And then we also have provisions for corporation tax payable. Provision for corporation tax payable. Now, you know very well that especially maybe companies in Uganda and any other country, basically, we have the 30% charge on companies. Now, at the end of the year, it's much likely you've not paid this tax. Remember, we paid, if, for example, your financial ends, let's say maybe December, you now, the obligation is for you to pay within the next 6 months. So in most cases, by the end of the financial year, you've actually not paid this tax. So you have to make a provision for it. And then we have the payment of dividends. Payment of dividends, of course, also, maybe you could have some dividends that are declared, and you have to maybe also make sure that you recognize this in the books of accounts. Now, all this is happening at the end of the year. Of course, as businesses, after balancing off, after preparing their P&L, after they realize that I've made some profits, they go on to declare dividends. Of money can, profits for corporations can either be given out in terms of dividends, or we can have what we call retained earnings. You get it? So companies can choose to either issue dividends or retain the money in the business as in form of retained earnings. Some companies do the two. They offer dividends partly, and part of the money remains in the business for maybe for future kind of purposes. And then we also have, of course, payment of dividends and then proposed dividends. Also, this should be also adjusted as well as the transfer to reserves. Reserves is basically money set aside for specific reasons. Like, for example, we can set aside money maybe to buy maybe a given machine. Money could be set aside for a given project and so on. So those are reserves. I think you've had this, especially with our country, saying we have maybe gold reserves in the Bank of Uganda, but also businesses can also have reserves. Reserves are part of equity. Yeah. So after adjusting and recording these entries, we prepare what we call the adjusted trial balance. We prepare the adjusted trial balance. Now, it is this trial balance that we shall use to prepare our financial statements, because at that point in time, we believe that whatever we're going to use to prepare the financial statements truly represents the organization at hand. Yeah. So very important for us to get that. So we will start with just something small. Here, we are looking at prepaid expenses. We are looking at prepaid expenses. So they are saying that these are expenses paid in advance. You get it? Like I gave you an example, like paying rent for the next 5 years or for the next year. You get it? Now they're saying adjustments should be made for expenses incurred in the financial year, but benefit the next financial year. Okay, I'm going to demonstrate this more with this example. They're saying KL Limited with the financial year ended 30th June paid an annual rent. K Limited with financial year ended this paid an annual rent of 24 million cash on 1st January 2018. On 1st January 2018. They're saying record the adjusting entry for the prepaid rent at the end of the financial year 2017-18. You get it? So it's very important for us to understand. Just a moment. So I want to demonstrate something here. And here we are looking at prepaid rent. Okay. So our question is saying KK Limited with a financial year ended 30th June paid an annual rent of UGX 24 million on 1st January 2018. So they want us to record the adjusting entry at the end of the financial year. Now, we know very well that if they have paid 24 million, as our annual rent, if they say they paid an annual rent, you know very well that the month has 12, okay, the year has 12 months. So these are this is the annual rent. These are the number of months. This is the monthly rent. So our monthly rent will be this divided by 12. So that is what we have as our monthly rent based on the question. You get it? Now, it's good for us to also know that the question says that they want us to record the adjusting entry for the prepaid rent at the end of the financial year 2017-2018. 2017-2018. Now that financial year, of course, it ends in 2018 June. That financial year ends in 2018 June. So what we shall basically go ahead to do (2017-2018). When you see 2017-2018, sorry. Okay. 2017. Let me just put in bracket, maybe. I don't know. Okay, the financial is 2017-2018. So such a financial year ends 2018 June. That's a normal Ugandan financial year. You get it. So if somebody paid on 1st January 2018, somebody paid the rent on 1st January 2018, what means that, of course, since our year is ending in June, and then they have also gone ahead to pay, of course, for the 12 months, they have paid an annual rent. It means that part of what they have paid will be taken to the next financial year. So there's a prepayment, because remember, they at first January 2018, we are remaining with 6 months. We are remaining with 6 months. 6 months is what is remaining. So what we shall do is we shall go ahead to recognize rent. We shall recognize rent by the 6 months. So we shall recognize rent for that period. And then we shall also go ahead to recognize the prepaid rent, the rent that relates to the next financial year, like that. Sorry if did I write this right? And then, of course, the other is, of course, we shall go ahead to credit our mode of payment, cash, by 24 million. You get it? Now, this is what somebody will do who understands the double entry. You get it? If somebody had seen this transaction, let's try to go back. If somebody had seen this transaction of KK Limited with the financial ended, this paid an annual rent of this on 1st January 2018. For them to do maybe a recognition immediately, this is what they will do. You get it? So this is scenario one. Now, scenario two is when this is actually realized at the end of the financial year. Now, if this is an adjusting entry, like the way they are calling it here, like they're saying record an adjusting entry, and this happens so much. They give you a trial balance, and then they give you additional information. They give you a trial balance, and they give you additional information. Now, what happens in this case is that if that comes as an adjusting entry, it means that initially this is what was done. Initially, this is what was done. They went on to debit rent with that value. Just this is 24 million. And then they credited cash with 24 million. Sorry. So if this is what was done, so the adjusting entry is coming in to tell you that part of this rent relates to the next financial year. You get it? So what we shall do if it was an adjusting entry to correct this. Now, in most cases, the person who does this maybe may not know. Maybe they don't know about the prepaid rent. Maybe they are not qualified as accountants as well. So when we are doing an adjustment, it means that we shall go ahead to adjust this value. We shall go ahead to adjust this 24 million back to 12 million. And that is why we shall debit our prepaid rent, and we shall credit our rent with 12 million. This also with 12 million. Now, at the end of the year, we don't really have this is not our concern. This is not a concern for us. You get it? Remember, this is when something is an adjusting entry. Adjusting entry. You get it? And then this is normal posting. So you can go ahead to recognize this transaction as it occurs by doing this normal posting. Now, if somebody doesn't know and something comes in at the end of the year, this will be the adjusting entry. This will be what was done. And then this will be the adjusting entry to make sure that this transaction now appears like this one. You get it? Because at the end of the day here, by us saying we are debiting, let's say we are debiting prepaid, it means that we are now recognizing a prepaid rent, which we are taking to the next financial year. And then we are reducing the rent account. The rent account now has 24, yet it should actually have 12 million. So that is what we are doing here. So that is one of the examples. I want to give you another example here. Okay. So I want to give you another example here. Now, when we are looking at adjustments, it's good for us to appreciate something small here. Now, as you can see, this is a question for Zebra today. So they are saying this is their trial balance as at the end of 30th December 2018. And they're saying this is before accounting for end of year adjustments, which we are looking at right now. So what we are saying is that you have your trial balance, but this trial balance will be before making certain adjustments. So this is our trial balance before we make any adjustments, as you can see. And now when you move down, after all that, your trial balance, of course, is balancing, well and good. Now they give you other information. Now this other information is basically the one that will include your adjustments. You get it? It's one that will include your adjustments. As you can see, they are giving us depreciation, which depreciation we've also seen as part of our adjustments. And then, of course, this is provision. We shall look at it, where a data disappeared and the allowance for at the end of the year is estimated at that value. We shall look at that value, but that is not something that we want. Unused stationery at the end of the year is valued at 3.4. Now, this is also this is something that you could look at as a prepaid expense. You already bought stationery. You know, remember, stationery is an expense. I know some people want to classify stationery as assets, but stationery is an expense. So sometimes you can buy stationery for the rest of the year. You get it. So if there's any stationery that is not utilized, this stationery will be like prepaid stationery, which can be utilized in the next financial year. Of course, it will also be under assets as well. Now, of course, the tax for the financial year, this is the corporation tax. Now, I want to zero on this. They are saying the salary expense includes salary advance to staff of 34.5 million. Salary expense includes a salary advance to staff of shillings 34.5 million. Now, let's go back. You see this question? Okay, this is stationery, but this is the amount that we have for our salaries. That is the amount we have for our salaries, 186,500. And they're telling us that that 186,500 includes an advance paid to staff of how much? 34.5. Now, this advance of 34.5 doesn't relate to this period. You get it? It relates to the next financial period. And since it relates to the next financial period, what we are going to basically do, we are going to exclude it. You get it? It's not going to be part of the other value of 186. You understand? So what we shall do, so this is 186,500. So what I'll do, if I want to make that adjusting entry, let me first show you how the ledger would look like, how it would look like if it was a ledger. So this is my salary account. So I'll draw up my salary account like that. Of course, I have a debit, and then I have my credit. Get it? I'll put it that far like that. So what is happening? I have my balance brought down that is coming from the is coming from the trial balance, which we have seen to be 1,865,000. And then we are saying that part of that value, 37.5, part of that value is 34.5, sorry, 34.5 million. That means it's like this. It is like that. So this could be in thousands, amounts are in thousands. Maybe UJEX. It's good to put this degree of precision. Maybe UJEX thousands. So what is happening? This amount has to be excluded from this 186. Maybe since I'm going to use okay, if consider this this is 186,500,000, and now this is 34,500,000. So this amount relates to this is advance. This relates to the next financial year. So this is what is happening. This is at the start before we make the adjustment. Now, after we make the adjustment, what we are saying is the adjustment will be, we shall debit our prepaid rent and we shall credit our rent account. Reason why we credit our rent account, remember, this is what we have. You get it. This is the amount that we have on the debit side, what we have as our salary. For us to reduce this value, we don't again debit, we have to credit. You get it. You understand now the principle of double entry, because it's going to we are going to reduce the expense. Then we don't have to go ahead to again debit, and that's why we are crediting here. That's why we are crediting in this case, and then we shall debit our prepaid rent to complete the double entry. So I'll open up my other account for prepaid rent. So we are saying we are going to debit. So I'll come here and debit, call it sorry, this is salary, not prepaid rent. This is salary in this case. Okay. So salary is worthy 34,500. This is also UJEX 1,000. So 34,500,000 will be there, and then I'll come here. I put it here: prepaid rent, prepaid salary. I don't know why rent is on my mind. It is 34,500, like that. So that is what I have, and that is what I'll do as a double entry. You get it? Eh? That is how the T accounts would look like. So in terms of course, ledger, this is how it is. For 500. So that is how it would look like. So this is your double entry. Now, for this question, for you to basically know, let's just check and see what did the question really need. What did it ask us? Did it ask us to journalize or prepare ledgers? Now, when you look at this question down, they said prepare an adjusted trial balance for the year 31st December 2018. I think you can see this is a very good question to really demonstrate what we are doing. So some question will ask you to prepare the P and L. Some questions will ask you to prepare the adjusted trial balance. You get it. So what means that from this transaction, once we balance off our salary account, this will now be what we are going to do. Since this side has less amount, this will now have a balance carried down. Which will be basically the difference between, of course, the 186 and 34 that you can press on your calculator. At the end of the day, you will now have 186,500 here, and you also have the same thing here. And then later on, you'll have your new balance brought down of how much? 152,000, like that. That is what you have. So you have this value. You also come here, you can also balance off this. But since if you're in the exam and an item only has one item, you really don't need to balance it off for matters of time. You get it for you to basically manage your time. So this is 34. You only balance off the other that are not what? So we have 34,500, which is the total. This is 34,500, and then you have your balance brought down still as 34,500. So when you go into your trial balance, if you're drawing up your trial balance again, which they are giving us a format here, I think you can see it has original trial balance. This original trial balance is what we have here. You just come and paste everything as you see it here. This is the trial balance. So you just come and replicate it the way it is. Already it has a debit and it has a credit. So you just come down. You just come down here and replicate it. Put the details here and put whatever is on the debit, you put what is on the credit, you put. Now, the adjusting entry, you get it. Where there is, of course, salary, where there is salary, we shall credit. We shall put an amount in the credit column here for salaries. You get it. And then where there is, we shall include a new item, prepaid rent. It will not have anything, any value here, but then it will have something in the adjusting by debiting it. And then our total here under salaries, we shall now write the 152, this one on the debit side. And then for the other prepaid rent, we shall write that one. You get it. So it's important for us to understand that. So I hope you've gotten more about prepaid rent, prepaid expenses. Sorry. So that is what would really happen. So they gave us a second example here, which you can use when you're preparing, when you're reading. I'll share with you these notes. I want to go to accrued expenses, or what we can call unpaid expenses. Now, in the previous example, we've been looking at a payment that we already paid. We paid in advance. But there can also be cases where a payment is outstanding, a payment is unpaid. You get it, huh? So we are going to see how that would be and how you'd go ahead to account for it. I'm trying to get a paper that can give us that picture. Okay, we can use this example for now. Maybe I'll get another one as we proceed. So they are saying, of course, accrued expenses, this is money that you yet to pay. And that's why we are regarding it as a liability. So we are saying that these are treated as current liabilities since they have to be paid within 1 year or within a year. So our example here, WT Limited has a financial ending 31st December. They are saying at the end of financial 2017, salaries amounting to 40 million couldn't be paid till January 2018. Till January 2018. So at the end of the financial year 2017, we had an accrued salary amount of over 40 million. So they are saying required, record the adjusting entry at the end of the financial year 2017. Record the adjusting entry at the end of the financial year 2017. Now, the double entry for this is us debiting salaries with 40 million and crediting salary accrued or accrued salaries with 40 million. Now, the reason why we debit salaries with 40 million is because this amount has not been paid. It is much likely that it is not within our trial balance. It's not part of the balance that we have for salaries in our trial balance. Remember, a transaction would only go through to the trial balance, either we've paid it if there are salaries, or maybe we've done another recognition. But if this comes as an adjusting entry, it means that this 40 million that was not paid until the next financial year in 2018, it means that it was not part. So we debit to increase the salaries that are within our trial balance. You get it, by the 40 million. And then we credit the accrued, basically, of course, recognize the payable. Remember, when liabilities are increasing, we credit them. So that is what we basically do for this case. So we credit our liabilities with 40 million. And we say that that value will actually appear within it will go ahead to appear within our liabilities, our current liabilities, because it is assumed that this value will be paid within a period of, at least a period of 1 year. So I'm going to show you something small. Okay. I want to show you something small. Now, for you to note the other question that we've just done, some of you may want to go back to that question to try to see. The other question is November 2019. The other question is November 2019. The one we just looked at, the one that has an adjusting trial balance. I would actually want you to try it out. You get it, November 2018. I think I earlier gave 2019. I gave other assignments, but I haven't gotten any responses of yet. I hope you're not sleeping. Okay. Was it this one? I think it's this one. Just a moment. Okay, so this is another question. For it is, let me just try to check. This is May 2019. May 2019. Now you will see that in every question they share with you, especially where they're giving you trial balance. Now, in most cases, because they know that the trial balance may take you a lot of time to prepare, they go ahead to give you a trial balance. So this is a trial balance for Jito, who are manufacturers of textile materials. So they have given us our share capital. Now, as you can see, share capital has a credit balance because it's part of equity. They have gone ahead to give us inventory and so on, and also different expenses, utilities, salaries, and so on. And then they have also given us rent and rates that value. Now you're going to see something here. They are giving us additional information. They are saying rent and rates had been paid for a period of January 2018 to 31st March 2019. Rent and rates had been paid for a period of 1st January 2018 to 31st March 2019. Now this is a prepayment. Let's just look at what is the end of the financial. The financial ends on 31st December. So if there is anything that is paid beyond 31st December, like you're saying, they paid for 1st January 2018, moving to the next year, because the year ends on December 2018. So moving to 31st March 2019 means that there is some portion that relates for the 3 months of the financial year 2019. And then they are saying that while utilities, shillings 4.8 was outstanding by the year end. Shillings 4.8 was outstanding by the year end. We have different adjustment entries here. Okay. This one, it has to prepare a statement of financial position and so on. But we have to make these adjustments. We have to make these adjustments. So I'm going to try out. So I'm going to start with my rent. So this is my rent. And they're telling me that it is 120,000. So they are telling me that part of this rent, you get it, had been paid, and it relates to the period of 2019. You get it. And they're also saying here that rent accrues evenly throughout the year. So it means that every month we pay the same amount of money. You get it, huh? So how I'll do this, basically, remember, how many months are this? From January to 31st March, these are 15 months. Because from this to the end of the year, to 31st December, those will be 12 months. And then from 31st December to 31st March, those are 3 months. The month of March, January, February, and March. So what I'll basically do have, so my rent as per trial balance, as per TB, is 120,000. Is 120,000. That is what I have. Of course, there's a degree of precision up over thousands. You get it? So it's actually 120 million. Since these are off dry balance calculation, so you can include their thousands. You don't have to include again 1,000 here and put it in bracket. So this was paid. It was paid for 15 months. 15 months. It was paid for 15 months. So monthly rent, these are rent and rates, is this value that was paid divided by the 15 months to get us to 8 million, because they have told us that rent accrues the same throughout the year. So if the trial balance has 120,000, and this is the rate that accrues for the year per month, my rent for the year will be the 8 million times 12. So my trial balance should have 96 million, not 120 million. You get it? But since it has 120 million, I have to adjust it by crediting my rent with the difference. Rent for next year, you can do the difference, or you can just do the 3 months times the 8 million. So you can see the total of this gives you 120 million. So for us to make sure that we are recognizing the right thing, we are going to remove this 24 million from this 120 so that it gets to 96, and that we shall do by debiting our, we shall debit our prepaid rent with 24 million. Sorry, this is 24 million. And we shall credit our rent with 24 million. The reason why we are crediting our rent with 24 million is because already they had recognized the whole amount under rent. So we are crediting our rent so that we can reduce it. And you remember what we said, when expenses are reducing, we credit them. So that is what we are doing basically. So that will be the double entry for our rent. Now you can put this into ledgers, just in case you need to. But if you can be able to think this through from here, then you may not have to. So we are going to now to look at our, the part of rent and rates. So they are saying, sorry, we're going to look at the utilities. So they are saying utilities worth 4.6 million was outstanding by the year end. So we go back and look at our utilities. Now the utilities that you're seeing here, this 5,400. If this is an adjusting entry, it means that this 4.8 is not included within the 5,400. You get it? Now when you're in an exam, you use a pen to make sure that you correlate these things. You get it? Somebody might see this as 55 for purchase of raw materials. So you can make sure that you do what? You relate these things using your pen. You can even do this thing, I think, in the 15 minutes, the first 15 minutes. should be okay. So this 4.8 is not part of this value. And what we are saying that this will now be an accrued expenditure because it is outstanding by the year end. You get it, has not been paid. So what we shall do basically, this is 5,400. So we'll have so 50, 40, 5,400, then adding the 0. Then outstanding is, they're saying is 4.8. 4.8. You get it. So utilities for the year, will be this value plus what is outstanding. Remember, we do the accrual concept. When you're recording and you're preparing your financial statements, you don't prepare and include only expenses that were paid. You include both expenses that were paid and also expenses that were unpaid, as long as the expense relates to that financial year. You get it. And that is what we regard as the accrual accounting concept. The accrual concept says that recognize expenses as incurred, not necessarily when cash transfers hands. And we also recognize income as earned and not necessarily when cash transfers hands. So you will tell me that this was outstanding, we didn't pay it. Why are we recognizing it for the year? It relates to that financial year. You get it, huh? Yeah. So it means the double entry for this transaction, we shall go ahead to debit utilities. We shall debit utilities with how much? With 4.8. And then we shall credit accrued with 4.8, like that. So you can go ahead to put this in your P&L. Now, some questions for you to know. Some questions may not ask you to go ahead to prepare, let's say, unadjusted trial balance. And doesn't mean that every time you have to prepare unadjusted trial balance. You can actually, because for example, like this question, I'll just move down to what they wanted. They wanted us to do the statement of manufacturing costs, to do the P&L, and to do the statement of financial position. So there was nothing like unadjusted trial balance. You get it. So for you, just have it in mind. Now, what happens is, if, for example, I have this, I'll tell you, if I'm going to record in my profit and loss, this is what I'll include under my operating expenses. I'll include only 96. You get it. Then I'll just refer the examiner maybe to working one. So if they want to know how I got my 96, they will come and get it here. Then if I'm recording for utilities, I'll definitely record 55,200,000. I record 55,200,000. You get it. So I don't need to draw up T accounts. I don't need to draw up an adjusted cash trial balance. Once I've understood the concept, I can just be able. The examiner will just come and mark this working and also mark this other working as well. And then they will mark this value within the statement of P&L. You get it. And then when I go to my statement of financial position, which is the balance sheet, I'll put this into my liabilities. I'll put this under my liabilities. And then for For this, I'll put it under my current assets. You get it? And that will be a way to recognize this transaction. I don't again put this in my P&L. I put what relates to the financial year. You get it? Eh? So we shall see that as we proceed. So any questions so far? Okay. So that is what happens when it comes to accrued expenses. Now we have what we call unearned income. And unearned income is like income received in advance. Income received in advance. For example, if today you pay me money for your level 2, maybe you're on level 1 and you pay me your money for level 2 and say me, I'm paying you this money, I'll claim it. Okay, I'll utilize it when I start studying my papers for level 2. That will be unearned income to my side or to the organization. You get it? Now, this unearned income to the business is a liability because you've not earned it. At the end of the day, you have to basically pay it back. You get it? Now, usually, of course, yeah, because customers pay in advance, just like we also pay in advance our expenses, you can also receive money from other people in advance. You get it? Now, at the end of the financial year, sometimes this income is still within the other income, and we have to exclude it. You get it? Huh? We have to exclude it and treat it as a current liability. Okay. So we have an example here. They are saying that KK Limited has a financial year ending 30th June. They're saying on 1st July 2017, KK was paid rent for 1.5 years amounting to 1,800,000. KK was paid rent 1.5 for 1.5 years amounting to 1.8. So this 1.8 relates to 1.5. You're required to record the transaction in KK's books when the transaction occurred and at the end of the financial year. You get it? Huh? At the end of the financial year. So our monthly rent will be this 1.8 divided by the 1.5 years. And 1.5 years is the 12 months plus the half of the year, which gives us 18 months that we are recognizing here to get 100,000. So ideally, it means that every month we pay 100,000. So the question is asking us to record when the transaction actually occurred. So remember, KK Limited financial ends on 30th June. They're saying on 1st July 2017, at the beginning of the financial year. You get it? At the beginning of the financial year. So since it's at the beginning of the financial, we have not utilized this rent. It is just the start. So you cannot recognize the overall expense. You get it? You cannot recognize the overall expense. So that is why we debit our cash because cash is coming in, and then we credit our unearned rent income. We credit our unearned rent income with 1.8. Remember why we are creating our unearned rent income is because it is the start of the financial year. We've not earned this income. You get it? A guy has paid you, it is New Year's Day, and they have paid you their rent. Okay, so what happens At the end of the financial year, we shall go ahead to recognize the rent that relates to the 12 months. You get it? Which will be the 12 months times the 100,000. The 12 months times 100,000. And then we shall go ahead to now remove this 1.2 from unearned income, because now we've earned it, and include it under our rent income, and recognize it and include it under our rent income. So it means that this has been earned for the year. So any balance, remember our earned income got 1.8 when we are paying the amount of money. If we are going ahead to recognize 1.2 at the end of the year, it will remain with a 600,000 under our unearned rent. That 600,000 relates, that 600,000 will now relate to a liability. So we shall have a liability within our books. Sorry. We shall have a liability of 600,000 in our books. Reason why we call it a liability is because our clients have not slept in the house or have not utilized the house for the next 6 months. So we shall only recognize it after those next 6 months. You get it? Huh? So if we are recording our P&L, we are calling our revenue for the year. Our revenue for the year will only be the 1.2, because this is what they have basically given us for the time they have slept in the house or utilized the house. And then the balance will remain as current liability until when we shall earn that amount of money. You get it? Huh? Yeah. So I hope you get that clearly, and I hope it sounds very well to you. Okay. So I want to also give a highlight on accrued income. Accrued income. Now, accrued income, just like we saw accrued expenses, accrued income is income you've basically earned. You've provided a service. For example, if we are finishing a financial year and I've provided you maybe teaching services, but maybe you've not paid me, I have the right to go and recognize that income or that revenue, because I've already offered the service. You get it? And that would mean that as I recognize it as my revenue, I'll again recognize an asset. You get it? In terms of receivable, I'll call it a receivable, income receivable. You get it? Huh? So it happens. As you can see, an example here, in 2017-2018, KK offered consultancy services to TTL and invoiced them Uganda shillings 3 million, which was not paid till 15th August 2018. KK offered consultancy services to TTL and invoiced them 3 million. So it was not paid until 15th August 2018. Remember, if it's a financial year of 2017-2018, it ends on, this financial will end on June 2018. So they later paid on 15th August. So they paid after the year end. Yeah. So somebody raises up a hand, please, Christine, go on. Okay, maybe it was by mistake. You can use the chat box in case if there's anything that is not clear. I can always respond to that. So since they didn't pay by 30th June 2018, then it means that was outstanding. So it was for us, we shall go ahead to recognize that income by crediting our consultancy services or consultancy fees. Remember, when income is increasing, we credit it from our ALICE model. And then if at all we want to recognize our receivable to indicate that these guys are yet to pay us, we now debit our consultancy fees with the same amount of 3 million. Yeah. So that is what we basically do. So I want us to see an example for this. Let me just try to see if this has it. Yes. So as you can see, explain the fundamental of NA3 enhancing qualitative statistics of accounting information, 5 marks. That one you must be knowing right now. A common question there. So this is a partnership and they're giving us their trial balance. So this is their trial balance, as you can see, debit, credit. So you must be able to interpret, by the way, trial balance at this level. If you're joining and you missed any of the previous classes, please access the previous classes to be able to interpret. Because for me, if I'm looking at the trial balance right now and I see website subscription costs, I know this is an expense. If this is renewal of audit software fees, this is an expense. Practicing fees to ISPAO expense. This is an expense. Staff development expenses, other operating expenses, staff salaries, and this. If I see audit fees and I'm seeing it on the credit side, then I know this is income. Remember, income has a normal credit balance. These are expenses because they have a normal debit balance. If I'm saying furniture at cost, this is a non-current asset. This is a non-current asset as well. Then accumulated depreciation. This one we shall know what they use for it as we proceed. We have accrued audit fees. Now we have accrued audit fees. These are audit fees that at the end of the year, we earned them, but they didn't pay us. You get it, eh? And then we have cash and bank. Of course, that is an asset. Then we have consultancy income on the credit side. Then we have some payables here. Then we have capital. Capital also has a credit balance. We have current account. Those are just to do with also partnership. Now, question comes here and says additional information and says an invoice to Moroconi Enterprises of shillings 4.5, an invoice to Moroconi Enterprises of shillings 4.5 for consultancy services provided in October 2017 had not yet been honored by their end. An invoice to Moroconi Enterprises of shillings 4.5 for consultancy services provided in October 2017 had not been honored by their end. And they're saying the information is not included in a trial balance. You get it. The information is not included in the trial balance. So what we shall do, since this is not included in the trial balance, remember what they have told us about our accrued income. They have said we go ahead to debit the income and okay, we debit the income receivable and then debit the income in itself. So the same thing we are going to do here. What we shall do for what we shall try to do for such a scenario, we shall go ahead to debit. This was it a consultancy? This was also a consultancy. These are consultancy services. So we shall debit our consultancy services, consultancy income. Now we shall debit our consultancy income because that is what is in our trial balance, consultancy income with the value that is there of 4.5 of 4.5. Sorry, this is receipt. Okay, let me just call this a credit, and then call this. Now I'm going to debit my accrued consultancy. Is it accrued consultancy income with 4.5. So the reason why I'm crediting my consultancy income with 4.5 is because this value is not part of what we have in the trial balance. Remember, what we have in our trial balance is this. Sorry. This is what we have. We have 20,000. So it's not part of this value. The 4.5 is not part of that value. So that's why we include it there. Now, we have, I call the other, I debited consultants income because this is what the account says. It's an account. Now, in the same way, of course, we have the accrued consultancy, which I've also gone ahead to, of course, go ahead to debit because it's a receivable. Now, I want to clarify something small here. Now, when you know your double entry, you see this part, this accounts payable, accrued consultants revenue and expenses payable. I've seen it. I wanted to explain something here. You see it is on the same line. We have 20,000 and then we have 30,000. And this is around interpretation of the trial balance. Now, the examiner will just put this all together and put a value here and put a value here. Now, yours is to determine what relates to accrued consultants revenue, what relates to accrued consultants revenue, and what relates to expenses payable. Now, accrued consultants revenue is an asset. So this 20,000 is for this accrued consult because assets have a normal debit balance. Remember, it's a service that we offered, somebody has not yet just paid us. So this 20,000 relates to that. Then expenses payable is this 3,000. Remember, they're on the same line. So you have to make sure that you know what belongs to the other. You get it, huh? I also said sometimes they can put something like interest. If they put interest here and the value is on the debit side, now that will be an expense. You know, interest can be both an expense and an income. Interest is an expense when you're paying it off a loan. Maybe you have a loan with the bank and you're paying an interest. Interest can be an income when you have a fixed deposit account and you have some money on the account and the bank pays you a given amount of money on, let's say, on a monthly basis or on an annual basis, no matter what the scenario. So that is something I needed to basically note. So these were all additional information. I wanted to see this Now, the partnership received a check of 20 million on 29th December 2017 in respect of outstanding audit fees. This check had not yet been recorded. This check had not yet been recorded. This one, you just recognize the check. You debit your bank and credit your outstanding audit fees. You get it, huh? That's the scenario. Okay. So I wanted to demonstrate that for you so you can appreciate. So that's how the accrued income would really work. This is just the principle. You can draw up ledgers, which ledgers are not really very common and needed. So you have to understand. If you understand by ledgers, go ahead to draw up ledgers. Okay. All right. Now, if at all, this 3 million that we've recognized here, that we've debited consultancy fees receivable of 3 million, and then credited our consultancy fees with 3 million. Now, here we've already done the recognition of the income. Now, in case TTL pays us, pays us, again, we shall not go ahead to credit consultancy income at that point in time. We shall not credit our consultancy fees anymore because we already recognized it at this level. At that point in time, what we shall just do, we shall debit our cash. We shall debit our cash and credit our consultancy fees receivable to remove this 3 million. And that is what we just did in the next slide here. You get it, huh? We shall debit our bank or cash and then credit the consultant's fees receivable. The reason why we credit this 3 million here is because already there is a debit of 3 million in our receivable. So if somebody has paid, we have to go away with this receivable. So we just have to counter post something on the credit side, which is the 3 million. Are we together? Yeah. So that is what we will basically do when it comes to accrued income. And then we have the next additional information or the next adjusting entry called depreciation. Now, every time somebody speaks about depreciation, what should come to your mind are what we call the non-current assets, or what other people call the fixed assets. Now, on a monthly basis, we have to recognize for the wear and tear. I'll give you an example. Today you own a car and you drive it per month. Now, your question should be, if you are trying to look at, for example, if you own maybe a boutique and you have your car, you use this car for deliveries and you also use this car for buying maybe a stock. Now, in most cases, business people ignore the cost of the vehicle. They only want to recognize the revenue, the fuel, but then they forget about the fact that this car is wearing out every day. So there is a cost that should be recognized for the wear and tear of the car. You get it? And that is why we bring in the aspect of depreciation. You get it? Just recognize the loss of value in the asset. So the same thing for any other business as well. So depreciation is the allocation of the tangible asset's cost over its economic useful life. You get it? So if, for example, if we recognize and say this asset will be here for the next 5 years, if maybe this asset was, let's say, 10 million, and it's going to be in existence for the next 5 years, it means that every year we shall recognize depreciation of 2 million. So at the end of the financial year, at the end of the useful life, this asset should be at 0 from our computations. Of course, we also have scenarios where this asset has a scrap value. You get it? So we are going to see. So imagine we are buying a motor vehicle worth 20 million. We are buying a motor vehicle worth 20 million. And the useful life of this motor vehicle is 5 years. It's 5 years. Now, you can also have a scrap value. The scrap value for most assets may be 0, but for some assets, it can actually be of a given value. Let's say 5 million. Like that. So depreciation, which we've now understood, depreciation is given by cost minus scrap value, cost minus scrap value, divided by useful life. Cost minus scrap value divided by useful life. So in this case, my depreciation will be 20 million minus 5 million which gives me 15 million divided by the useful life, which is 5 years. And this at the end of the day will give me my depreciation to be at 15 divided by 5, that is 3 million. So the 3 million is my depreciation. It is my depreciation. Now, depreciation has two methods. We have what we call straight line depreciation, and then we have what we call reducing balance method. Now, for this case, this is straight line. So what would happen is that for our motor vehicle, if I'm looking at depreciation, and then I'm looking at the net book value. Now, net book value is what remains after you've deducted your depreciation. Sometimes this is called the carrying amount. Sometimes this is called the carrying amount. So for year one, our depreciation for the motor vehicle app for year one, at the end of the year, remember this is the end of year adjustment. Our depreciation is 3 million. So our net book value, remember, we bought this vehicle at 20 million. If it has depreciated by 3 million, our net book value will now be the 20 million minus the 3 million, which will give me 17 million. Now my year 2, since straight line depreciation, it will still be the same. So my net book value will be the 17 million, which was the previous value at the end of the year, subtract the depreciation for the period, which is 3 million, to get me to 14 million. Year 3, it will still be that. So this will be 14, subtract 3 million, give me that. This is year 3, sorry. Then year 4, it will be 11 minus 3, give us 8 million. Sorry, this will also be 3 million. And then for our net book value will be 11 million minus the 3 million, which gives us 18 million. So year 4, the depreciation is still the same. We will have the 8 million subtract the 3 million. This is year 5. And remember, this is our final year, so this is our scrap value. So this is what we've just done here. We are saying that our depreciation will be 15 million divided by 5, which is giving us the 3 million. This 3 million is the depreciation per year. And this is what we basically have. We recognize this depreciation, and this is what we have as our net book value. So this goes to the P&L. This goes to the P&L. When somebody says P&L, they mean the profit and loss. They mean the profit and loss. Or it is also called the statement of comprehensive income. Comprehensive. It is also called the statement of comprehensive income. Okay. Now, let's wrap text of this. This value, this net book value, is what you recognize under your balance sheet, which is the statement of financial position. You get it? So that is what will basically happen. Now, if this is straight line depreciation, where we are saying that our vehicle is losing 3 million every year to end up with 5 million as scrap value in the last year, there are certain assets whose depreciation is not standard as it is here. I think in life you must have interfaced this, that there are some assets that will depreciate maybe highly in their maybe first years or last years, and then that will mean that the depreciation every month will be totally different. You get it? Huh? So what happens is, of course, this depreciation can also be represented in terms of percentage. Depreciation can also be presented in terms of percentages. Now, in most cases, for examination purposes, they will always bring you depreciation in terms of percent. Yet they can bring the other case as well, but what is very common is the depreciation in percentage. So they will say Motor vehicle, they'll say motor vehicle depreciation. They will give it, let's say, and say 20% on cost. You get it? Now, when somebody says 20% on cost, this depreciation is straight line. This depreciation is straight line. They can say either on cost, or they can clearly bring out the word straight line, as we shall see. Straight line depreciation. Now, if they say on cost, if we have our cost value as, let's say 20 million, in this case, we shall not use the other formula that we've just used of cost minus scrap value and so on. We shall just get the 20%, and multiply it by the value, the cost, which in this case is 20 million. Which gives us 4 million. So that is how it will be for depreciation on straight line. Now, we also have cases where we have depreciation on reducing balance. Now, as this is straight line, we can have this depreciation on reducing balance. You're going to see what will happen. So if this is still motor vehicle, and then they say depreciation is 20% on reducing balance. If they say that depreciation is 20% on reducing balance, what would mean that if this was our motor vehicle, the depreciation one will not be the same within every period. And then the depreciation will be now, the percentages will now not longer be subject on the cost value, but we shall use the reducing balance. We shall use the net book value in every period. I'll give you an example. If they are saying, of course, if they are saying our reducing balance is 20% on reducing balance, this is how we would calculate our depreciation. First, of course, we know very well our cost is 20 million. And then we have, of course, we have our depreciation percentage, the depreciation percentage, which they are giving us 20%. Now, if it is year one, depreciation, we just even include it here. This will be depreciation, and this will be net book value. Okay, so if this is year one and we want to calculate our depreciation, it will definitely be the 20% times the cost, which is 4 million. Now, in the first year, the reason why we say 20% times the 20 million is because in year one, the net book value is the cost itself. In year one, the net book value will be the cost in itself. And that is why either you're using straight line method or you're using reducing balance, the depreciation will always be the same in year one. You get it? The depreciation will be the same in year one. But for straight line, the depreciation will be the same throughout the different years. If these were year one, year three, year 5, that will be the value of depreciation in your year 1, year 2, year 3, year 4, year 5. You get it. And all this, as you consume it, it will get back to the 20 million. Now, if it's reducing balance, of course, our depreciation in year 1 will be 4 million because we have subjected this on cost. Now, in second year, okay, let me get the net book value. The net book value will be the 20 million minus the 4 million. Let me just do this, which gives me the 16 million. Now, when it comes to year 2, how I'm going to calculate my depreciation? Since it's reducing balance, I'll not do 20% times 20 million because it's not straight line. The depreciation has to be different. What I'll do equal 20%. This time I'm going to multiply with the net book value, which is the 16 million. But I can still also calculate it here to demonstrate for you. It will be the 20 million. Just remove the commas. It will be the 20 million minus the accumulated depreciation of the previous financial year. To get me to 3.2. Now there's something I've brought in here and I've just said is the word called accumulated depreciation. Is what we call accumulated depreciation. Now, the word accumulated depreciation is very, very similar to depreciation. And what goes there might also be a bit similar, but accumulated depreciation is basically depreciation for the years that this asset has been around. If this asset has been around for only 1 year, the accumulated depreciation will definitely be the depreciation for that period. You get it? The word accumulated is accumulative, so it is accumulated. Now, if it is year 2, we are going to see how the accumulated depreciation will be. So for our depreciation, we are saying we do 20% times 20 million minus 4 million, which 4 million is our accumulated depreciation for us at the start of the year. Now, what will happen? Our new net book value, the new net book value would definitely be the 16 million, which was the net book value at the start of the year, minus 3.2 to get us to 12.8. That will be our new net book value. Now, the accumulated depreciation will now be the 4 million, which was for at the start of the year, plus the 3.2, which is the depreciation for this year. So you can see we've now started accumulating our depreciation. Now let's do for year 3 for you to learn more. So year 3 will be to calculate the depreciation still to be 20% times 20% times, we are going to get our, of course, 20 million less 20 million is our cost, less the accumulated depreciation at the start of the year, which is 7.2. So it will give me that. It will give me 2 million 560,000. And then my net book value will be the net book value at the start my net book value as at that period will be the net book value at the start less the depreciation for the period, giving me the 10,240. You get it? And then the accumulated depreciation will definitely be the 7.2 plus the 2,560, giving me 9,760,000. I can try one last year, year 4. Year 4 will be depreciation, the percentage, times my cost, which is still 20 million, minus the accumulated depreciation at the start of the year, which is how much? 10,240,000, like that. That is how my depreciation shall be. You get it? So the principle is, for reducing balance method, we get the cost, we get our cost, and less accumulated depreciation for the previous year, at the start of the year or at the end of last year. And that should be able to give us the net book value. This that we are calculating is the net book value. You get it? Is the net book value. Sorry. This is the same thing. Let me just write this. Sorry, this is 9. The accumulated depreciation is 9. I've taken a wrong figure. 9,760,000, like that. So that is how our. So it is the cost minus the accumulated depreciation times the percentage to give us that value. So our new net book value will be the previous net book value, deduct again the depreciation for there to give us that value. And then the accumulated depreciation will be this value, which is the depreciation of the previous period, accumulated depreciation of the previous period, plus the depreciation of the period, giving me 11. So as you can see, accumulated depreciation keeps on growing. You get it? The net book value keeps on reducing because the asset is depreciating, so its value keeps on reducing. Depreciation. Depreciation, this is what is recognized in the profit and loss every year. So I think you can see it's reducing. It's reducing balance, reducing depreciation. When it came to straight line, it was the same throughout. You get it, huh? It was the same throughout. So the examiner will always give you either straight line or reducing balance. I want us to just try out something, one number, and then we call it a day. Okay, so we have a scenario here. We have a scenario here. I think you see, they're saying in our additional information, the firm's depreciation policy is as follows. Computers is at 20% straight line, and furnitures and fittings is at 5% reducing balance. Now, when you go up, when you go here, you see what we have here? This is the accumulated depreciation they have given us for at the start of the year. 1st January 2017. Let's move up. Okay, right here. So you can see the furniture at fittings at cost is 3,500. The computers as at cost is 4,800. They have gone ahead to give us accumulated depreciation for each of these assets. And they have also gone ahead in the additional information here to give us the detail of the firm's depreciation policy. You get it? Now, if I want to calculate the depreciation for computer, which they are telling me straight line, which means that the depreciation is the same throughout. What I'll just do, I'll get the 25%, which is my depreciation rate, and I'll come and subject it to the cost of computer, which is 4.8. You get it? Which is 4.8. Now, when I come here, depreciation for computer, I have, of course, the rate is 25%, I'll say, equal sign. Of course, this is a formula. I'll put my formula, which is 25% times 25% times the depreciation, the computer cost, which is 4.8. The computer cost, which is 4.8, like that. So it will give me 1.2. So you have to, of course, write this formula, and then you write the answer. If you're writing a written exam, the examiner wants to see this computation. You get it? Huh? The examiner wants to see that computation where you've got the 1.2. Now, if I'm doing the depreciation for furniture and fittings, remember, for furniture and fittings, they told me that for it is at reducing balance. It's at 5%. Now, reducing balance. And then I also have details of furniture. I have furniture. Furniture's cost is at 3.5. And then its accumulated depreciation is at 175. Now you saw for computer, I didn't come and look at accumulated depreciation because I just used the cost. But when it comes to furnitures and fittings, this is what is going to happen. The depreciation will equal, remember, we said is equal to cost minus, okay, let me put is equal to the percentage of depreciation times bracket cost minus accumulated depreciation. Remove this. So this is the formula. So my depreciation percentage in this case is at 5%. So times the cost of this furniture and fittings, which is at 3,500. It is at 3,500. 3,500 minus the accumulated depreciation, which is 1,500, which is 1,500. It's 175, sorry. 175, like that. So this should be able to give me my answer. You get it? This should be able to give me my answer. Maybe just to, can be that. Then I can have my answer down here. Let's put an equal sign. This gives me 166. You get it? So you see how we have basically done this. For this, we just for the computer, we just did 25% of the cost. Of course, you can even go ahead to write for the examiner the formula. You can write for the examiner the formula and say that if it's straight line depreciation, it is just depreciation times the cost, which is 25% times the 4.8, which gives us an answer here of 1.2. And then we've said that for this, for reducing balance, we subject on the cost minus accumulated depreciation. You get it? Or what some, remember, this cost minus accumulated depreciation is the net book value, is the carrying amount. That is how we get that. So this value is what you take to your P&L, your profit and loss. And then this is also what you take to your P&L. Now, what you recognize in your statement of financial position will be basically, of course, this 1.2 you've gotten, you have to add it on your accumulated depreciation that you started with. So this 1.2 that we've gotten here, we shall go ahead to add it onto our, sorry. We shall go ahead to add it onto our accumulated depreciation. You see, computer already had 1.1 accumulated depreciation. So the accumulated depreciation at the end of the year will be the 1.2 that is in trial balance plus the 1.2 depreciation for the period. And then for furniture, the same thing. We shall add the 175 plus what the 166 that we've quoted. So when we are putting this value in the statement of financial position, we shall now do the 4.8 less the 2.4 and get the value of the computer. The same thing. We shall see that when we get to that level. Today, I just wanted to basically take you through this additional information. You get it, huh? So there are examples here that you can really use to be able to learn. I'm going to share this with you as well. Yeah. So unless we have any question, what if I say 20% of the new break value? Okay. Somebody asked a question here. What if I just say 20%? Yeah, Martha, you can actually do that. You can do that. But I just did this for especially for people that are new learners that may not easily pick that. But once you master the principle, you can make adjustments. Somebody was trying to ask here. I think it's when we were trying to. If you're calculating the depreciation, instead of me doing again cost minus the accumulated depreciation at the start, I can just do 20% times this net book value. You get it, huh? Same principle basically. Yeah. So thank you so much. Let me just share these notes right away on your WhatsApp group to be able for you to be able to go through. In case you have any other questions, make sure that you post those onto the WhatsApp group. I can be able to answer. So thank you so much for being part of this. Again, this is Samuel Ibanda of Achievers Professional Trainers. I look forward to seeing you in the next class. So be blessed and God bless you. In case you've not yet subscribed to our classes, these classes are conducted online, and we encourage you to join us and be able to learn as much. So thank you so much. Thank you, Martha. And thanks everyone for being part of this. See you next time. And make sure you don't miss, and make sure that you always come very early.